This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with Andrew Young. Andrew, there's a lot going on this week, so let's jump right into it. The big story of the last 72 hours has been the hack, I think it was on Friday, of Binance, or at least that's the headline, $600 million. Can you explain to our audience just what's going on here?
Yeah, it was pretty crazy. Happened actually late Thursday night. I was just scrolling through Twitter and suddenly crypto went full apocalypse environment because essentially what happened is a hacker was able to mint 2 million BNB, which is the token of the sort of both the Binance exchange as well as the Binance blockchain. They were able to essentially hack into this thing called the BSC token hub, which is essentially BNB's blockchain bridge, and mint 2 million BNB, which is equivalent to about $600 million. And then what happened was Binance is relatively centralized as a chain. There's not that many validators, and a lot of the validators are sort of closely associated with Binance or sort of their affiliates. And so they were actually able to halt chain entirely. So no more blocks were being produced. And that allowed them to essentially freeze about 80%, 85% of the hack of the BNB that was stolen, as well as freeze some of the stable coins that the hacker had sort of traded the BNB into. So the big ones being Tether. So Tether both blacklisted the hackers Tether, as well as they froze I think roughly 460 million of the hackers 570 million. So the hacker was able to get away with 110 million through the bridge, which I believe they bridged out mostly. I'm actually not totally sure. I think most of it went through to Ethereum. And so, yeah, I mean, just kind of another day in crypto. Sort of exposes one of the things we've talked a lot about how bridges are the biggest targets for hacks in crypto. And pretty much just shows that no one's immune because Binance is obviously I think quite literally the largest single company in crypto. And even their chain was able to get hacked. And then at the same time, it does show that there are some, I guess, a lot of weaknesses to centralization, but in this case, they were able to coordinate the halting of the chain because of the relatively small validator set. And so it does show that centralization in some respects can be good, I guess, because in this case, they're able to sort of bring everything to a halt relatively fast. Yeah, I don't know. Like, what were you watching it on Thursday night as well, or what do you think?
Like a lot of people, I think like a lot of people, I have more questions than answers. Maybe you can just help explain a couple of these things to us. So we've talked about bridges being hacked, and obviously, it's a big attack surface area, and the bigger the amount of money in the bridge, the more valuable that honeypot becomes. And we've also talked before about individuals having their accounts stolen because of phishing attacks and what have you, or their accounts hacked. But I want to just understand this a little bit better. Like the emission rate or the creation rate for Binance is something that is part of the blockchain. Like how exactly do you mint 2 million BNB? That's the part I don't quite understand. Like, I can understand stealing it out of a wallet, because of a vulnerability in like the smart.
So they essentially stole it from the bridge, which already had. So
but they didn't. Yeah, just like that's something that's worth clarifying. Like Binance's inflation rate wasn't adjusted. Like, wouldn't that require
no
kind of tax to actually do that? Yeah.
Yeah.
Okay.
So I believe the way it works is BNB wasn't originally native to the BNB BNB blockchain. I mean, they've rebranded it so many times; it's kind of hard to remember what it is. But BNB initially started as an ERC20 token, so they built a bridge to bridge sort of this BNB ERC20 from Ethereum to the BNB chain. And there's actually a separate blockchain that Binance had initially created through Cosmos, though it wasn't EVM compatible, so it didn't really get much adoption. So essentially, because of that, there's a bridge that has BNB on it, and the hacker was able to essentially steal 2 million BNB from that. And then what they did is they quickly they tried to transfer it out by either trading the BNB into stablecoins, which they could then bridge out, or bridging the BNB out to other chains. So I think Ethereum was the single largest one. It received about $50 million of BNB. Presumably,
do we know who did this?
No one knows.
No one knows.
No one knows. It was a relatively sophisticated hack, so we don't know yet. I wouldn't be surprised if it comes out that it's sort of maybe the North Korea team again. They seem to be behind most of the huge hacks like this.
I think there's a couple of points here. I mean, one is bridges don't really seem like the best way to, create interchain interoperability, right? Like the whole idea is that you have these different assets that are native to different chains. How do you move them between chains? And so that, apps can be truly composable, meaning they can actually interlock with each other, and liquidity can be truly pooled together. And it just seems like one of these things where it's just not really working that well. And I don't know what the status quo, I think, has to change. And then the other point is centralization versus decentralization. And, I think it's interesting that they were able to do that very quickly. Is it a bad thing that they were able to take some of this money back? Does that show that this is, decentralized in name only? Or is it a sign of coordination within a network to try and limit the damages? I think some people who listen to this podcast would remember the DAO hack on Ethereum, where the first organization, crypto native organization, the DAO, raised a bunch of money, and then that money was hacked. And what ended up happening is they reversed the blockchain, forked it, and as a result, we got Ethereum and Ethereum Classic. Now, at the time, I remember it wasn't like, oh, a bunch of validators who all know each other are going to get together and quickly reverse it. It was more of a decision within a network that was like, okay, we are interested in long-term network health. What is the thing that is going to put us on that path? And do we all have a vested interest in working together to roll this chain back? And it was contentious, but in the end, I think it was something around 80 or 85% of nodes, I guess was miners really, and large holders kind of agreed to this. And as a result, they rolled it back. And effectively, like the origin story of Ethereum is a situation where a blockchain, which is supposed to be an immutable ledger of transactions, was mutable. It was changed. And I think at the time, a lot of people, I remember, people said that this might be sort of an original sin for the network, and as a result, it won't scale. But that was wrong, right? In the end, Ethereum is the dominant chain for smart contracts. It's the one that's got the most developers and applications. So it's not like it's some kind of, fatal flaw that it rolled itself back. I think in this case, it does seem different. Yeah, I'm just sort of, talking about this, but I'd love to get your perspective.
No, for sure. Well, I think it sort of just depends on the values of the community. I also think that crypto is a very much different environment than it was 4 or 5 years ago. Yeah. Nowadays, people are far more focused on adoption, and whereas the early community was more, call it maximalist in nature, and decentralization and sort of censorship resistance was the most important thing by far. Whereas I feel like nowadays people just like, they're willing to say, okay, what's the thing that would actually like makes the most amount of sense? Let's just do it. Which in some ways is more pragmatic, but in other ways is sort of less values driven, which I think a lot of people would agree with. Particularly with BNB. BNB is a blockchain where the native token, most of the value is actually being driven by the sort of revenue of a centralized exchange, i.e. Binance. So I don't think like BNB was never thought up of as like a fully decentralized, censorship-resistant blockchain. It can't possibly be that because the native token, the vast majority of its value comes from a centralized exchange and how well like the centralized exchange is doing. So
Right.
I don't think the BNB community is not the same sort of community as early Ethereum community. And I also just think the overall environment is less geared towards decentralization at all cost and more geared towards essentially adoption and essentially adoption, which I'm not sure if it's good or bad, but it's definitely more pragmatic.
Well, on the subject of pragmatic versus dogmatic, MakerDAO, which many would consider the most successful, one of the more successful DAOs that's been functioning, through a couple of market cycles, sports the DAI stablecoin, has announced that they haven't announced, the smart contract hasn't announced it, but I guess the foundation has announced that they plan on buying treasuries as part of the collateral basket that underpins the DAI stablecoin. So for people, who have heard us talk about stablecoins in the past, there are centralized stablecoins, which are issued by companies and are backed by reserves held in a financial institution. The most well-known, probably what is one of the most well-known, is USDC. The other one's USDT. But basically, USDC, Circle is the issuer, and their assets are held inside of US banks. And then you've got decentralized stablecoins, where the collateral is held in a smart contract. And typically, because the collateral is also crypto assets, including stablecoins, but also more volatile assets, the reserve ratio or the collateral ratio is higher than 1-to-1. So in Circle's case, they might have like $1 of treasuries for every dollar issued. In MakerDAO and the stablecoin DAI's case, I think it's 1.5. I'm not totally sure on that, but there's an over collateralization ratio. And it's worked well, and we don't need to explain the mechanics, but it's always been crypto assets that's been held as collateral. And now we're hearing about treasuries. Andrew, help. What does this mean? What's going on?
Yeah, so MakerDAO is a very good example of what we just talked about. They have made the bargain, I would call it a bargain, over the last couple of years to try to move away from decentralization to more what I would call centralization sort of initiatives in order to scale adoption of the DAI stablecoin. And in some ways, it's worked well. The market cap of DAI has exploded. It hasn't kept pace with USDC, but nevertheless has sort of 50x in market cap over the last couple of years. But in a lot of ways, it's also kind of destroyed the core value prop of what DAI was supposed to be, which is a completely permissionless, completely censorship-resistant stablecoin. And nowadays, it's actually mostly, or at least I think it's around 50% backed by USDC itself. And now what they're doing is actually using some of the assets held in the MakerDAO sort of treasury to invest in real world assets. We call them RWAs, in this case being treasuries issued by a banking partner. And it's actually it created a huge rift or split in the MakerDAO community. You had some people who were what I'd call more focused on the decentralization and sort of long-term vision of DAI, voting against this and being very vocal about it. Whereas you had sort of Coinbase and others on the other side promoting this initiative, which in a lot of ways, again, I think it makes DAI more, DAI is sort of, in my opinion, is kind of throwing out the baby with the bathwater in the sense that it's becoming less and less permissionless. It's very clearly, it's going to be harder for them to sort of carve out a niche with at least vis-a-vis USDC in terms of value prop, but at the same time, it's helping them, it's making the platform more stable. So it allows them to lower their collateralization ratio, which therefore spurs growth. I'm just not sure if long-term it's going to be the right move. So I don't have a definitive opinion on this. It seems like they've been sort of going down this path for a long time. What is interesting though, is within MakerDAO, there's now there's a huge rift in the community between what I'd call the decentralization maxis and the growth maxis. And it seems like the growth maxis have continually won over the last couple of years, which has been great for the market cap of DAI, but may sort of imperil its future long term.
Do you think decentralization maxis versus adoption maxis will be a dynamic that defines this industry going forward? Not just in Maker's case?
Yeah, I don't know, like Maker is interesting because it sort of pivoted away from what it originally was. I think for the most part, people, they sort of migrate to projects that fit their values. So MakerDAO is an interesting case study because it sort of changed its values over time a little bit, from decentralization maximalism to what I'd call maybe growth maximalism. And so I think historically what happens, and I think will happen for the most part, is there'll always be some infighting, but for the most part, people will just migrate to projects that fit their values. And you're starting to see a little bit of that with DAI and MakerDAO. There is a sort of alternative called RAI, which is a fully permissionless, only uses Ether as collateral. And it has a very small market cap though, but sort of sticks truer to its values. And you saw that with Bitcoin, where Bitcoin had Bitcoin Cash, sort of forked into 3 different versions, and then you just let the market decide which one's best. So I guess the bigger thing is really what will the market decide is best, is sort of the slower approach of decentralization maximization, which is very much like the tortoise path. You give up short-term growth, but potentially you build a stronger base, versus the sort of hare approach of optimizing for growth, which allows you to jump to an early lead, but potentially the foundation is not as strong. So you're more susceptible to attacks. It's very much, I guess, it's sort of a choose your own adventure, I would say. And I think in some sectors, the hare approach will work way better. And others, the tortoise approach may work way better. It also may just come down to luck. If some projects that take the hare approach get hit by huge attacks, whether that's sort of regulatory or just you could also think about this in terms of pushing out features really fast. Yep. It's potentially less secure, but you get to grow faster. So you can maybe get away with that, but if you're able to get away with that and push growth and then sort of improve the security on the back end, then it actually is a great strategy. It's higher risk. So I guess what I'm trying to say is I don't really know, but I would say there's different sectors within different subsectors within crypto where people are taking different approaches. And it does seem, at least within the stablecoin market, the hare approach has led to has pretty much all the stablecoins that are the biggest stablecoins in the world have taken the hare approach of maximizing for growth over decentralization. But there's an argument to be made that MakerDAO has carved out the decentralization approach very, very well. And now they're trying to compete with USDC and these other centralized stablecoins in a game that they may not be able to really win, because USDC is obviously, because of its centralization, is able to move at a much faster pace.
Mm-hmm. Interesting.
But
there's an interesting quote. There's an interesting quote. So there's a very famous management thinker. His name's Peter Drucker. He's like known as like the father of business management theory. And I was working on something else, and what you said reminded me of this, where he said innovation and entrepreneurship are not root and branch, but one step at a time. They're pragmatic rather than dogmatic. And I think that's sort of interesting. It's like you mentioned even the word pragmatic, like a more pragmatic approach versus a dogmatic approach. What is going to succeed? I think in the era of, when he was writing in the middle of the 20th century, that was probably true if you were working at Johnson & Johnson or something. But when you're dealing with like a new technology paradigm and you're trying to reinvent the world, it takes a lot of chutzpah and a lot of like fervent belief. And I think that's been the sort of dogma of the dogma of decentralization, has been something that's defined a lot of really success in this industry. And I'm just curious to see as it becomes more commercial, more industrialized, and seeks to truly drive, billions of new users, whether or not there these inevitable trade-offs. Why that's sort of framing it wrong, but whether these trade-offs are inevitable, right? Whether we have to, make these kinds of decisions about, decentralization versus growth. I don't know. We'll see. To your point, it's hard to know, but
Yeah.
it's definitely to me it's a central theme. Like it's a central thread of what's going on in crypto, right? Is this decision or this tension, I guess, between these two forces.
Yeah, and honestly, the best approach is probably to. Actually, I don't even know the best approach. One approach is obviously sort of do the hair at the start, get network effects, and then on the back end, decentralize. So that's the approach called progressive decentralization, which a lot of VCs are big believers in. A16Z is sort of I think they're actually the creator of this term. And the idea is you sort of race out for growth initially, get network effects, and then decentralize in the back end. So that by the time the platform is hit sort of mass scale, the platform is also fully decentralized. There's all sorts of things. One of the approach that one team took obviously was Terra, was to use Bitcoin as its underlying collateral, and it was sort of far too centralized in that approach, because Bitcoin obviously. They just didn't have the right governance structures, but also Bitcoin has sort of collapsed over the last 6 months, even as inflation went up a ton, which was obviously one of the main sort of macro theories of how Bitcoin should outperform. I'm just kind of curious, what are your thoughts on Bitcoin right now? I saw some news on Paul Tudor Jones, for example, who came out sort of less bullish on Bitcoin. It seems like the macro bull case for crypto has faded. Just curious your thoughts on that and sort of how you see Bitcoin doing over the next couple months in this uncertain macro environment.
Sure. Well, Paul Tudor Jones said that he still has an allocation to crypto, but I think he's less convinced than he was when he first made that allocation in 2020, when he said, I think it's supposed to be an inflation hedge. And obviously, with the recent market volatility across all asset classes, the US dollar has kind of steamrolled a lot of assets, including Bitcoin. It has not it's not stood apart in any sort of meaningful way throughout this crash. And I can't really blame it. I mean, we're talking about global currencies that are supposed to be safe havens, like the yen, for example, getting absolutely blown up. As well as gold and other so-called safe havens, blue chip stocks, bonds, you name it. So what hope does a $400 billion market cap asset class have in the context of that kind of short-term volatility? But like zooming out and looking at it, there's a couple of things that I think are really interesting. And we're going to put this out in our weekly note for 9point. I encourage you to sign up, digital.9point.com, to sign up for that newsletter. But basically, we're going to do like a chart dump where we're looking at a bunch of different things. One is the volatility in Bitcoin and Ethereum has declined over the course of September from, I think in Bitcoin's case, a little over 70 to a little under 70. So I think it's about a 10% decline compared to the broader VIX. The VIX index, which tracks volatility in broad equity gauges, which is up around 40% in that same period of time. Also at the same period of time, Bitcoin has held pretty firm around its so-called realized price, which is basically the sort of average cost that all Bitcoin has been accumulated. There's still a little room to go below to where the average accumulation point is for all whales, which is closer to 15,800. But in general, this $19,000 level is kind of held in all right. And if you look at past cycles, it's only ever gotten to that point at 3 times in its history. And right now, Bitcoin is basically break even at around 50% profit to loss ratio, meaning essentially that you've got, about as many people are in the money as out of the money. It's gotten as low as, I think, 41% in its history, previous cycles like 2014-15, also the 2017 crash. Interestingly, the 2020 market meltdown, the COVID meltdown, the profit to loss ratio was down to 47%. So a little more people out of the money than in the money, but not by much. So we're actually getting kind of close to that level, which I think is something that people really should be paying attention to. And then just zooming out and talking about a theme that we spoke about last week, which is what are the other qualitative and business catalysts are occurring that make the case for Bitcoin. Of course, there's always going to be the store of value trade. And, I think for the unbanked and for people living in crisis zones and the rest of it, that's a thesis that's totally valid. But we're still seeing a lot of enterprise adoption of Web3 and crypto, and Bitcoin's no exception. Last week, we spoke about MasterCard. This week, you see Google Cloud is accepting crypto, which is an interesting development. You're also seeing BNY Mellon, which announced last year that it's launching its custody business for crypto assets, going live. So it hasn't been deterred by the bear market. And this is frankly something we see with a lot of big companies. If BNY Mellon, the oldest bank in North America, founded by the first Treasury Secretary, Alexander Hamilton, decides, slow moving, old school institution decides it's going to do something, it's not going to be deterred by, moves in the price. And I think that's going to be the big theme for enterprise adoption of crypto and Web3 over the next little while as well. So I expect that to be a tailwind too. So you can never pick a bottom, obviously, but it's starting to look increasingly likely based on all the data that we've now analyzed that a floor is near, if not in already. So that's something that I think people should be paying attention to. And if you're interested in hearing more, yes, go to digital.ninepoint.com, sign up for the newsletter, and also there you can check out our Bitcoin ETF, the only carbon neutral Bitcoin ETF in the world. And that's my pitch for Bitcoin to end the show. This has been a great chat, Andrew. I think I'm going to write up that decentralization versus growth like a dichotomy or thesis for the note as well. So I'll put some more thought to that. And sorry?
Yeah, no, and one thing I would say is, I think one thing you can maybe talk about as well in your write-up is, if you look at historical stock returns, value stocks have historically outperformed in bear markets because people there's almost like a flight to cash flow generating companies, which is sort of how you define value stocks, i.e. high earnings relative to market cap, whereas growth tends to be unprofitable, more risky companies. And so what's interesting is that growth companies outperform in bull markets, whereas value companies outperform in bear. And I think, I have a theory that the decentralization maxis potentially also outperform in a crypto bear market, because people are more focused on risk reduction versus just pure growth metrics, whereas the sort of growth maximalists tend to outperform in bull markets. So it kind of, the way I sort of think about it is it almost mirrors the way growth and value stocks move. That's just a theory, though. I'd be curious to see the data.
Bitcoin is the value stock of the crypto space, in other words.
Yeah, exactly.
Interesting.
Which is funny though, because it has no revenue directly to the token, unlike proof of stake tokens. So I don't know, but yeah, I think overall it's definitely the sort of safe haven. It provides that.
Yeah, absolutely. Well, we'll see. We'll take a look at the data and see if it supports the thesis. All right, that's it for today's episode. Thanks, Andrew. That's great. We're going to have some more guests on the next little while here. I've got a few in mind we'll be reaching out to. Some themes that I think we're still interested in is on the gaming side. So I think we should start lining up some gaming guests. Would be curious to hear input from our listeners in terms of who you'd love to have on the show. We like to think we can reach out to people. So let us know and we will do our best. That's it for today. We'll see you next time. Take care. Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.